Hey, I'm Austin Appleby, head of R3 Protocol at R3, and you're watching Taking Stock.
Stand by. Markets in retreat here on Wall Street just one day after another round of all-time highs. That makes 8 out of 10 sessions here on Wall Street in positive territory on this trading Thursday. Investors taking a little bit of a breather, also taking their fair share of profit taking here on this trading Thursday. This is day 9 of the ongoing federal government shutdown continues. Welcome to the show, one and all. Today is Thursday, October 9th. Two very important pieces of business to get to. First and foremost, happy birthday to Tony Shalhoub, great American actor. We know Tony's a big fan of the show. Thank you for watching, Tony. And this is true, happy International Pizza and Beer Day to all who celebrate. That is certainly a holiday I can get behind. Investors across the major market indexes started the day in positive territory, very quickly hit selling territory. The tail of the tape, we are expected to see the S&P 500 finish down 0.3%. Pretty comparable story for the Dow Jones Industrial Average, down 0.5%. The New York Stock Exchange Composite Index down 0.8, and the small caps down 0.6% as well. We will bring you later on the broadcast the latest you gotta know out of Delta, because shares of the airline giant are absolutely soaring after knocking the cover off the ball. Their quarterly earnings earlier today, a beat on both top and bottom earnings. But with that, my friends, time now for our favorite tradition here at the New York Stock Exchange, the team from Ameriprise Financial here at the NYSE to do the honors for the closing bell. Striking the gavels for Tony Shalhoub's birthday, also to end the market day here. We told you off the broadcast, off the top of the show, I should say, of the 11 sectors in the S&P 500, only one of them is in positive territory, and it did so fractionally. That is staples. We do have energy, industrials, and materials. Leading losses to the downside. As for the Dow 30, NVIDIA hitting a fresh set of all-time highs on the day. Salesforce and Merck the leaders in the Dow, while the laggards today, Boeing, Travelers, and Honeywell. Let's now bring in Max Gochman. He is the Deputy Chief Investment Officer at Franklin Templeton Investment Solutions. I got the whole title right.
You got the whole thing. I know it's a long one.
My man, yeah, but it's worth it, though, to get to, and it's worth it to have you on the show. Thanks for joining us here today.
Thanks so much.
Give me your perspective here. Q4 rolling on. We know historically it's a very strong time of the year for equities. How are you positioned as October rolls along? We inch ever so closely to the holiday season.
So we're responsibly bullish, and what I mean by that is we are overweight equities. We think the US has more room to go. We don't like Europe. We're not too much of a fan of China after its run up, but we like the rest of emerging markets, in particular South Korea, Taiwan, and Brazil. And overall, across fixed income, we like credit, but we're very careful because spreads are really tight. So it's really about being careful. Also, this is becoming a little more controversial, but we still like gold. We think gold is actually a good way to add some luster to your stock positions as they're getting a little stretched.
Responsibly bullish, that was the phrase?
That's right.
Do the tightening credit spread conditions concern you, or do you see opportunity there?
They do concern me, but I think that's where it really becomes a bond picker's market, and I think it's really important to pick names where you still have some compression that's left. Look for good fundamentals. There are companies like that out there. But also, if you go outside of credit and you go outside of the US, there's good opportunities in gilts and some other sovereign bonds as well.
That's awesome, because you got a nice eye on the global markets and what goes on over there. It's not just here in the US. Talk to me about how you're approaching the conversation over the state of labor here in the US, inflation pressures. We know we got the Fed dealing with both sides of the dual mandate, but we've heard from the Fed more this year. Maybe we got to focus a little bit more on the labor side of the mandate, less so on inflation. What are your expectations for the upcoming FOMC meeting, if you have any?
Well, I think they're going to cut. And I think the Fed is going to cut about as much as the market expects, which is actually more than a lot of strategists that I've talked to. I think, yes, there's more kind of a question about Fed independence. I think that it becomes more of a question after May, which means the markets start discounting it around March. I think the bottom line is you're going to see us get a lot closer to the neutral rate in 2026. The markets are anticipating that. I think labor is going to still be okay, and we're kind of in this, I'm almost going to say stagflation light environment where growth is middling. It's not bad. It's okay. Inflation is going to start coming up as you see those effects of tariffs bleed through. It's not going to be all at once. It's going to be gradual. Long term, I think it sets us up for kind of a sad decade. So think Japan's last decade, that was really bad. This is it's a little sad. But near term, it's still attractive. And I think the really important thing in this market as an economist is don't fight the tape.
Don't fight the tape. We say don't fight the Fed, but I like don't fight the tape. Maybe even
Don't
a little
fight
bit
either.
better. What is the Franklin Templeton outlook on the crypto majors right now? What's on your radar?
So really like ETH, really like Sol. I think one of the things that we've seen, which is really critical, is kind of a debasement trade, right? Moving away from the dollar. So speaking of gold, it's now the number 2 asset in sovereign reserves, beating euro, still obviously well behind the dollar. I think we're going to start seeing more businesses looking for fast cross-border transactions, look for new rails, and that's really where, tokens like Sol come in. I think we're also going to see more from ETH as companies look to build on the platform. There's not a lot of ways for the average person to get into like a real VC ecosystem. There is with ETH, actually.
I got less than 30 seconds with you. What's on your radar as the ongoing federal government shutdown plays itself out? At what point do investors need to pay a little bit more attention?
I don't think it's something we really need to worry about too much right now. And I think the reality is there's going to be a rollback. I don't think we're going to see the administration actually not pay to furloughed workers. I am a little worried about my flight back to San Francisco tomorrow because, TSA, ATC, not getting paid doesn't make me feel super happy. But aside from that, I think it's something that we are going to get through. We've done this many times before. It's always a lot of political theater.
It's always political theater. We heard those FAA concerns from Delta and Ed Bastian. We'll talk about that more in just a second. Max Gochman, incredible guest to kick off the broadcast. Thanks a lot for joining us. Great to have you.
Thanks for having me.
Josh, going to grab your microphone, and Todd, my man, you and I are going to go for a walk. Oh, you're all fine. Let's head up this way. All right, as we walk over to the NYSE notable boards, we're going to bring you the latest odds on Polymarket event contracts, specifically to the question Max and I were just talking about. How long will this federal government shutdown go on for? 14% chance in the eyes of Polymarket participants that it will end by Wednesday, October 15th. It is like amazing here. 86% chance it'll end on Wednesday the 15th or later. Check out those odds on Polymarket to learn more. Todd, we were just talking about Delta. Look at this, often soaring 4.2% here on the day, a huge gap up after reporting a beat on top and bottom lines and raising guidance. Corporate travel demand remaining strong for the airline giant. They're facing cancellations. They're facing delays as the government shutdown continues. The average one-year price target is at 70. Look for some analysts here on Wall Street maybe to adjust those figures given the fact that Delta has risen that guidance. Todd, finally, we take a look here at Levi Strauss. They are set to report right after the bell today, down 0.5%, expected to report lower Q3 revenue. Of course, the company manufactures most of its products in the Asia-Pacific region of the world. We'll look to see how the trade and tariff-related storyline plays itself out. This stock is up 39% year-to-date and up 100% off of its April 9th lows. All right, folks, when it comes to the world of oil, do you know the difference between WTI Cushing and WTI Midland? Maybe you don't, and if you don't, we've got just the thing for you. Take a listen.
Welcome to Texas, the land of oil.
Buckle up and keep your hands and your feet inside the ride at all times. And that ride is the oil market roller coaster.
Oil has played a major role in the shaping of the region and the economy. For 50 years, West Texas Intermediate, better known as WTI, has tracked that influence, a key price marker for U.S. oil.
I appreciate your getting back to me on that price change last evening. I was able to meet my competition just like that.
If you're new to crude benchmarks, you've probably wondered, what's the difference between WTI Cushing and WTI Midland?
We've been watching WTI crude now.
We are seeing a big move in crude this morning.
Energy is the runaway winner today.
Midland and Cushing are two completely different quality crude oils in the United States.
They differ in geography, logistics, and market relevance. Let's head to Cushing, Oklahoma, once known as the pipeline crossroads of the world. Cushing is where oil futures go to retire. This is the official delivery point for NYMEX WTI crude.
WTI was a benchmark created by the New York Mercantile Exchange. It was traded in the pits, and it was physically delivered to Cushing, Oklahoma. And it was delivered there primarily because of its connectivity to refineries in the Midwest and also pipelines to the Gulf Coast and other locations around the country. I think it was groundbreaking at the time. It was 1983 when it went live. It was really the first time that an exchange created a futures market to bring transparency to crude pricing. At the time, Cushing was really the crossroads for all of the transportation for crude around the U.S. It's always been the case that crude oil production and quality profiles change over time.
Where is all this oil coming from that we're storing here in the U.S.?
The United States is effectively becoming the world's sponge for oil.
The U.S. was the biggest importer of crude. It was the biggest economy in the world, and it relied on the Middle East and other imports of crude. Fast forward to 2010 or so, and you had Canadian crude production ramping up. You had North Dakota crude ramping up. West Texas Intermediate was ramping up because of the shale production. So all of these new crude streams were coming online at the same time, and all of them were flowing into Cushing.
Ty just mentioned those rising stockpiles of crude, and all that oil has to be stored somewhere, of course. There's so much of it that storage space may soon run out.
They couldn't store it all. There's 80 million barrels of storage. There still wasn't enough to handle all of that flow.
There's more crude coming into Cushing than going out.
2015, the U.S. lifted the export ban.
Shouldn't we be able to sell our goods to whomever we like?
Congressional leaders have agreed to lift the nation's 40-year-old ban on oil exports.
The industry got together and they actually worked to reverse the Seaway pipeline that was set up to take crude from the Gulf Coast and deliver it into Cushing for distribution, to reverse those pipelines so that all of that inflow of crude from North America could make it to the Gulf Coast for exports.
Let's head south to Midland, Texas.
A lot going on in the oil patch right now.
In the heart of the Permian Basin, members of Congress are getting a firsthand look at what fuels America.
I'm on the Gulf Coast, where crude oil is received, stored, and where tankers arrive to transport U.S. oil to markets around the world.
We are pretty much sitting right on top of 50 billion barrels of recoverable oil, making this one of the largest oil fields in the entire world.
If Cushing is where the U.S. oil industry started, Midland represents its future.
Midland WTI is a very light, sweet crude that's very popular on the international markets because of its production of gasoline and diesel.
The Permian produces over 5 million barrels a day, more than some OPEC countries. The Permian is not just an oil powerhouse, it's a global-scale producer, making it a strategic pillar of U.S. energy independence and a force in shaping global oil markets.
Let's start with Intercontinental Exchange, this new Houston crude oil futures contract. Why the need?
Everyone realized that the archaic market that we had landlocked at Cushing, Oklahoma, really wasn't sufficient for the future. Most of the oil that's produced in the U.S. goes directly to the Gulf Coast. It never sees Cushing, Oklahoma. So it was imperative that a new market be focused upon and created. This is a historic day for the industry.
About 2/3 of the crude that's pipelined out of the Permian Basin lands in Houston. We created the ICE Midland WTI contract. The contract code is HOU. HOU is the only physically deliverable contract on the Gulf Coast. And we worked with Enterprise Product Partners, which is a huge midstream company with about 17 docks in the Houston area, to establish a spec for Midland WTI. That's a big point because the crude at Cushing is known as DSW, although it's still named in the market as WTI. It's actually got an entirely different quality profile, and refiners globally look to HOU as the actual convergence place of financial markets and physical pricing for Midland WTI. Over the years, that has become even a bigger deal because the Brent benchmark was created to help price crude production in the North Sea. But over time, North Sea production significantly declined and new crude streams needed to be added to the basket. This is a natural solution to ensure that there's enough physical oil underpinning the futures market. So traders can now manage their exact arbitrage exposure between the US and Europe by trading the futures spread between ICE Midland WTI and ICE Brent.
And that's the difference between WTI Cushing and WTI Midland. Both are critical, but in today's global energy market, knowing the difference isn't just technical, it's strategic.
Let's do it, folks. Welcome back to the broadcast. You are watching Taking Stock, still live down here from the trading floor of the New York Stock Exchange. And joining me now, one of my favorite guests we've had on the show before, Mark Newton, Managing Director and Global Head of Technical Strategy at the one and only Fundstrat. Mark, welcome back to the show. Nice to have you here as always.
Great to be back.
Talk to me about the charts, the technicals. What are you seeing in terms of chart setup as we advance here in Q4 for the broader market?
Yeah, it's a little interesting. There's been a little bit of divergence in some of the sector rotation of late. So tech obviously is still going up. We have sectors like consumer discretionary hitting new 2-month lows, communication services rolling over. So the market is really a shell of what it was a few months ago. Breadth has been slowly retreating. If you strip out technology, I mean, the eco-weighted S&P has been really unchanged since July. So, NVIDIA, of course, new all-time highs. Everybody's going to talk about that, and it's wonderful. But when you take out NVIDIA, you take out Apple, the market really has been going nowhere. Meanwhile, you have the dollar at new 2-month highs, and so that's really a different change. So we've seen a little bit of stalling out in some of the emerging markets. I think that's interesting. Sentiment slowly but surely starting to come back as well. So this past week, we saw AAII showing the highest bullish percentage all year long, 45%. The issue is that bears are still elevated. So we have about 35% bears. So we're not extraordinarily optimistic and speculative, but it's something to watch because the positioning had the highest level of inflows last month in September since 2021. That's ETFs plus mutual funds. Extraordinary amount of money coming into the market suddenly that largely had missed this whole rally since April. They're up 35% in about the last 26 weeks, of course, almost a 6-month gain, and now people are starting to get in. So that gives me a little bit of pause because, of course, August, September, everybody expected the pullback, and it didn't happen. Now we come to October, and they say, oh, it's off for the races, and everything is great. Well, might not be so quick to think that.
Do you attribute that inflow here the last few weeks or so to further expectations of interest rate cuts? We just got one a few weeks ago, expectations for October and December?
I think people are very comfortable now with where the economy is. They know that the Fed is going to cut, at least probably twice this year and another twice, but by this time next year. So we have 4 cuts now priced in the curve, really over the next year. Meanwhile, the economy seems to be chugging along. I know there's some issues with the labor market having slowed materially, and that is an issue. But the economy's okay. Earnings have come in phenomenally. And let's look at the next few weeks. We have no major earnings. We have no central bank meetings. We have largely no economic data because of the shutdown. Yeah. So what are people going to trade on? Well, hopefully that's technical analysis. For now, things are still intact. I think the S&P is going to 6,800. I am a little worried about the possibility of a pullback, likely starting in about 1 or 2 weeks, that takes us on a little bit, probably a 3 to 5% pullback into November, largely based on positioning, sector bifurcation. That's an issue, and the sentiment having gotten a little bit too frothy in the short run.
Yeah, you and I were talking before the interview started about the way industrials, materials, technology, a few other key sectors have been performing as of late. Do you see a bit of a rotation happening? And on the technicals, do you like certain sectors over others given our current positioning?
Yeah, look, I have to still lean on technology. I know it's overdone, but it remains the best spot, not only for earnings, but also for short-term momentum. I like financials. I think it's underperformed of late, but that's a really interesting sector, and utilities for the fourth quarter. I think you have to avoid energy. I think crude is going down, at least down to the low 50s, if not lower, between now and year end. That's a problem, I think, but it is going to be helpful for inflation. So that's something that healthcare, of course, has had a little bit of a bounce. I think it's still tough to trust healthcare, still in this ongoing, battle between both sides trying to bring down drug costs, and it's going to be very, very difficult. So it's still right to like the market. For those that like to be short term, we're getting close to a time when we're finally going to see that much a way to pull back, but I think it's going to be viable into November. I still expect to see markets higher into year end. So I'm not a big bear, but there are finally some warning signs, at least technically, that have been absent for months.
Yeah, we know the market averages 3-5% pullbacks a year. It's been a while since we've had a 5% pullback, so we'll see what the rest of Q4 has. And I hope you'll come back and be on the show again soon. It's great to have you, Mark Newton of Fundstrat. Always nice to have you here, my friend. Folks, coming up here on the show after a very quick break, an interview you do not want to miss with Will Rind of Granite Shares. We'll be back with much more Taking Stock coming up after this. Welcome back to the very special Tony Shalhoub birthday edition here of Taking Stock. Now for our next one-on-one interview, Will Ryan, founder and CEO of Granite Shares, joins us here on the trading floor of the New York Stock Exchange. Welcome to the show. Welcome to the exchange, Will. Great to have you here.
Thank you. Great to be here.
Tell me your view of the markets as Q4 rolls over here. We're continuing our push deeper into the quarter. How do you think markets are set up? Bit of a pullback and some profit taking today, but all-time highs have been the recent story.
That's right, and I think that this will continue. We're in now a cycle where we're waiting for maybe 1 or 2 rate cuts before year end. Inflation seems to be in check. You know, some of the geopolitical tensions that we have seem to be dying away a little bit. So I think now focus on earnings next, but things look so far so good.
What are you seeing in terms of investor interest into high yield ETF products specifically, and what does Granite Shares offer for investors who want to learn more about that game, certainly are familiar with the name Granite Shares, but still always trying to become smarter investors?
Well, look, high yield ETFs have been a huge thing this year, not just this year, but last year as well. One of the reasons is we're talking about ETFs that generate high yields from selling options. And in this particular environment where markets are at all-time highs, maybe people are starting to think, how much further can they go? And maybe I should be thinking about income as opposed to, buying here, riding this out. So we've seen a lot of investors buying income, effectively, thinking about converting some of that growth into income through options-based ETFs like our Yield Boost family. And that's been a huge success story this year.
Well, before the show started, you and I were talking privately about leveraged ETFs. I mean, that is a real big thing. I've been covering the space now for a long time, and I feel like I'm having more interviews here in 2025 about the leveraged ETF space than I ever have before. What does that look like in terms of people using Granite Shares?
Yeah, no, this has been a massive story as well, and particularly leveraged ETFs on single stocks, and particularly the AI stocks, NVIDIA, AMD, obviously still, despite the fact we're down today, we had another good day for NVIDIA, but this has been the year of AI yet again. Huge enthusiasm for AI still in the market, enthusiasm for NVIDIA, for AMD, some of the other AI stocks, and crypto as well has been another big theme.
How about enthusiasm for gold? We've been talking about it throughout the week. Gold per ounce now topping 4,000. I know you got some gold ETF products as well.
That's right. I mean, who would have thought, gold at $4,000 an ounce? I thought maybe we'd see 4,000, but not quite so soon this year. It's been an incredible run, a little bit of a pullback today. But again, I think this is about the global environment of, government debt at all-time highs. Doesn't seem to be any credible plan in terms of reducing that from any government, really. And this is about de-dollarization. The dollar's lost about 9% year to date against trade-weighted basket. So gold has become really the alternative reserve to the US dollar, surpassing the euro. And I think people looking for diversification, looking for stores of value, and gold is that.
Yeah, and overall, we seem to have more interest in ETFs than we do individual equities at this point in the game. And so we've really seen that the whole landscape shift on its head. So we're really grateful for you being on the show, and we'll do it again soon. Will Ryan to Granite Shares. Thanks a lot for taking the time and joining us here at the New York Stock Exchange. Folks, don't go anywhere. Much more Taking Stock coming up after this quick break.
Welcome back to Jargon Translator. I am your host, Scarlett Sieber from Money 2020, and today we're going to be decoding jargon for a word or words such as BSA. What does that mean? Bank Secrecy Act. And no, despite the name, it's not about keeping your bank account a secret. Quite the opposite, in fact. It's about making sure your bank tells on you like that annoying little brother. The BSA is the US's first big anti-money laundering law, passed way back in 1970. Think bell-bottoms, Watergate era, but instead of disco, Congress was worried about the drug cartels and tax evasion, and yes, this was actively happening. It requires banks to keep records and file reports for certain transactions, especially for that cash money over $10,000. You've all seen it, you all know it. The idea was, if the mob is moving millions of suitcases, maybe don't let them do it quietly. Why was the BSA created? The government wanted a paper trail. Before the BSA, criminals could literally waltz into the bank with duffel bags full of cash and nobody asked questions. With the BSA, banks became the frontline detectives, filing reports called currency transaction reports and later suspicious activity reports. So yeah, banks got drafted into law enforcement whether they liked it or not. Fast forward a bit, enter the Patriot Act in 2001. After 9/11, Congress supercharged the BSA with the U.S. Patriot Act. Now, banks had to go even deeper. Customer Identification Programs, CIP, the roots of the modern Know Your Customer, which we've talked a lot about on the show. Tighter monitoring for terrorism and financing, expanded powers for the government to demand records. Basically, the Patriot Act took the BSA from keep an eye on the mob to track every dollar everywhere all of the time. Why does this matter today? The BSA plus Patriot Act combo is still the backbone of U.S. anti-money laundering law. Every time you get annoyed uploading your driver's license to open a fintech app, thank the BSA. Every time a bank freezes your account because the computer flagged it, thank the BSA. And regulators love it. Just ask HSBC. They paid almost $2 billion in fines in 2012 for failing to follow it properly. So, the Bank Secrecy Act, not really about secrecy, definitely about banks and the reason compliance officers exist. That's your jargon translated. Back over to you.
Welcome back to the show. One and all, get you quickly updated about the ins and outs and everything that went on here on Wall Street today for not quite a history-setting Thursday, but we have had many history-setting days up until today. The S&P 500 finishing down on this trading Thursday 0.3%. The Dow down 0.5%. The NASDAQ composite down, but only fractionally, while the Russell 2000 down 0.6%. As we told you at the top of the broadcast, staples really the only sector in the S&P 500 in positive territory, with energy, industrials, and materials leading losses to the downside. Something we did not get to talk about on the show today, Ferrari, that is ticker symbol RACE, having its worst day as a publicly traded company. Shares of Ferrari down on the day 15%. All of this sets the stage for tomorrow here on Wall Street, 10 a.m. consumer confidence, at least the October preliminary numbers we will get crossing the tape. We were chatting about it with Mark Newton of Fundstrat just a short time ago. And before we get to that, tonight in prime time, I made the catch. The New York Football Giants hopefully will not be losing another game at home in MetLife against the division rival Philadelphia Eagles. We are way too excited. I get way too excited for bad Giants football every year. That's going to do it tomorrow morning, 9 a.m. NYSE TV Live and FinTech TV Live, counting you down to the open. This is Taking Stock. Go Giants, and we will see you again tomorrow.
Let's go Giants!
Yeah, oh, dude, you and me both.